Hello, this is Jeff Sirkin, trading the Ichi Moku clouds, shorting a stock with puts. Shorting is when you make money when a stock or market goes down. I'll be using put options to mimic shorting because shorting a stock has unlimited risk. If you don't know how to use put options, here's a very brief, simple idea of how it works. A put is the right but not the obligation to sell a stock at a certain price. So, for example, if you own a put at a $10 stock price, you have the right to sell that stock for $10, even if the stock moves down to 5. So, for example, buy a $10 put on XYZ company, $10 strike, for $1. The stock moves down from $10 to 7. You just made approximately $3 minus the $1 cost of the put. One contract is 100 shares. So it's a gain of approximately $200, not taking into account volatility and the delta. Just as a simple explanation if you've never traded a put. I'll be bringing up some stocks on charts that are shortable or were shortable and where people might have made money on it going down. I use Live Trading Alert Scanner by Ed Carter to find possible trades. I think it's the best scanner in the world, and it's called Live Trading Alerts. I will bring that up also. I brought up some possible opportunities from the scanner for this video. So first, bring up a chart with the Ichi Moku channels like this. Now I'm going to get rid of all of the other indicators on my chart right now. So I'm going to take these off for now and only leave up the moving average and the Ichi Moku. I left up when earnings comes out. If you saw my other videos, here's a very, very brief review of my two others, how to trade the cloud. Let's just bring up a SPY, for example. Okay, so here it is. Here are the rules on this on trading. I'm going to delete my past drawings. And here's the cloud. So you see the red cloud and the green cloud as I move my cursor. Maybe I can get something to write with. I'll get a doodle here. Okay, here's one. Here's the green cloud, a red cloud, here is the baseline. The red is the baseline. The blue is the conversion line. And if you go over my past two videos, there's more detail. Okay, I'm going to go into entering a short trade in a minute. The lag line is the olive color. And here are the rules to enter a short trade. So come over here where it might have been short. Okay, so here's the rules. I'm going to try to make this bigger. This is going way back to a year ago approximately. And here's the rule. The candle must be red for shorting, for going down. the price that you enter the trade on must be lower than the previous day's price. The red baseline must be above the blue line. You see it here. So the red is above the blue. The olive line must be below the cloud for a short. Do not enter near the earnings date. And for this method, price must cross below the cloud after being in the cloud. So you see that right here. See if I can get my see, so here's the prices in the cloud. And now this is not a buy because it's still in the cloud. This would be a buy for a short right over here. This would be a buy signal for a short for a put. And notice how it was correct. And it stayed down a while. If one had a long-term option and stayed in it, it would have been really good money coming all the way down here. I usually get out of my trades as a rule when the next candle, my trades are short term, and I get out if I'm depends on the profitability. I'll get into that in a little while. You put the stop in the middle of the cloud. So if you enter over here, you would get out of the trade if it came back up here. So for example, let me get my crosshairs, if they permit it. It's not allowing it for some reason. Maybe here? Nope, for some reason it's not working. Maybe this? Well, maybe it works on equities and not ETFs. But I'd go back up into the middle. If it goes against me, I'll get out right back here. So what would that be? Approximately, I don't know, 440 or so. Okay, so let's bring up some charts I found to trade short. Maybe it won't let it because of it. I got it. See here, it would be about 443 would be my stop because it's approximately the middle of the cloud. So I'd enter here. If it goes against me, I'd have a loss up here. So let's bring up some charts to show what I had been looking at. And I'll show you my rules and if I would get in for a short. There's a shipping company. Okay, and here is, just for example, it's not one I would trade yet for a short, but just to show an example. This would be a long 12, maybe over here. Take it more recently. You see here, it's in the cloud. It came out of the cloud, went back into the cloud. Just after earnings, I think that was earnings over here, it started to go down. I would not trade on the first day, but this day here, on August 29, I would be buying a put, and I'll show you how to get the puts in a few minutes. See, so I would have made money the first day. But actually, probably this one I wouldn't get into because the cloud to the right is still green. So let's show the rules one more time. Okay. So it's in the cloud. It comes back out of the cloud, goes in the cloud, and here would be a buy, a possible buy. But look at the lag line, 26 days before today's price 26 days ago. It's not below the cloud. And the green here is it's not a trade for a put because the cloud to the right is green. Let's take another one as an example. Let's do hood. Okay, so here would have been a good trade right here, but earnings was here, so I wouldn't have done it. I'll show you some of the ones I've done. These, when I went long, I did well with. I didn't take the flags off. Okay, just as an example. I would not trade through earnings, but if one wanted to take that risk, this would have been a trade. The lag going back here would have been below the olive line. So here's the red. So here it was in the cloud. It came down through the cloud. It's in the cloud. Out of the cloud here would have been the buy of a put. And probably I would have gotten out on that gap down and made some good money. As Rick Sandler said of hit and run candlesticks, a gap is a gift. I learned a lot from him. So here would have been a fast one-day move. And it follows the rules. The lag, when you got into the trade, the lag here is below the cloud. The cloud to the right is red. The red line is above the blue. So that fits the rules. Also, this line here, the 500-day moving average, tells you get out because it went under the 500-day moving average and then came back up. So it's a sign that it would not stay below the 500-day moving average. Let's bring another one I planned. NCLH. Okay, so here's a good example. Okay, here is earnings. Don't trade before the earnings. The candles are here in the cloud over here, and this would have been to get into the trade down here, and then it gapped down. I would get out on the gap and make, I don't know, $200-300 if it were one contract, approximately. Some people, when they have a small win, 50, 100, 25, 200, say, oh my God, I'm not going to take only 100. I'm not going to take a $200 win here. That's not enough. But look what happened. It went back up, so one would have lost. Remember, a put is when you make money on it going down. So take profits, take profits, take profits. You can always buy it back. My win rate is 72% using the clouds. And here's one I've traded a lot, KWEB. If you're okay with Chinese stocks, some people don't like Chinese stocks because they're corrupt. But here's a good example. I've been in and out and in and out and in and out of puts on KWEB for many, many, many months. Okay, so take a recent example. Here I just made a little. I got in over here and got out over here, a few dollars, but I've made a lot of money in other times in the past on these. I made some good money around here. When was that? In January on puts. Let me see if I can show it. That was around over here. Yeah, see the entry would have been here. I wouldn't have gotten out here. It's too small of a move. Here would be a win. And then you'd wait. Once you're in a trade and you get out, watch it every day and get back in. So you'd make a little here, over here. On the put, notice is below the cloud. The red line is above the blue. At that time, the cloud to the right is red. The lag was clearly below the cloud, going back in earlier in the year. And then you just follow it. Watch, so you take a few dollars over here and just wait. Had I waited here, I would not get back in because it's a green candle. Had I waited longer and been more patient, it would have made more, but still it was a little profit. So I wait. I see the green, so that's not an entry. It's coming back up. See, on a put, you'd never buy if the price is going up. So the price was up. Here might have been a buy, but it's a doji, so I'd wait. A doji is when, almost a doji, when the price at the open of the day is very, very close to the price at the close of the day. It shows that the bulls and the bears were fighting and nobody won. So now just keep watching. Here's the green candle. You don't buy a green, you don't buy, it's going up. But now it's going down. Here would be a buy again on the red candle. The red here over here, maybe I should make a mark just for the fun of it. So it would be, for example, over here. You see my line over here? I buy here because you've got the red line above the blue. The candle is red. The price is below the previous day. The olive line is below the cloud. And the cloud to the right is red. So here's a buy and watch what happens. And then I'd follow it, make money here, and probably get out over here. And again, everyone says, well, why didn't you wait? You would have made more money. Well, how do I know I would have made more money if I waited? Now, if you keep watching it, so you get out here at a good $300 or $400 on a contract. How much? What's the difference here? Let me see. How many dollars is that? 26 to 24. So say about 150. So if you had 5 contracts, that's what, 750. So now here you got out. So just watch and wait. Don't get in here. It's red. I would just watch and wait. This one I just wouldn't enter because the price is above the previous day. Here the price is below, but the candle is green. Over here is below, but the candle is green. The candle is green. I don't enter. I do not enter my trades until about 4:45 Eastern time in the afternoon. Okay, so now here might be another entry. You see the red line above the blue line. The lag is below the cloud. At that time, 26 days out, the cloud was red to the right. So here would be a buy. And maybe get out here because the cloud is the candle, not the cloud. The candle is green. I would exit over here or maybe over here. Let's go to more modern times. KWB, EB, I'm in and out of it a lot. Okay, so here I made a small amount of money over here, just a few dollars, but even $20 I'll take because here's why I took the 20 and was thrilled to death with my 20. Okay, so I bought the trade here following the rules. The red below, the red above the blue. The cloud to the right is red. The lag is below the cloud. Ideally, the lag line pointing down, which is the olive. But here's what happened. It went against me. So I got in over here, And it went against me, and I figured I didn't have that many contracts. Maybe I lost about half up at this point on this red candle. But I saw the candle was red and it did not close in the cloud. So I just waited, and it came in my favor here and continued in my favor. And when I was profitable right about here, I made about $20 and maybe $25. No, I think it was $40. Here was 40. I think I made. I was thrilled with the $40. And again, it was, oh my God, it's only 40. Don't take it. It's not enough. But yes, it's enough because it had gone against me and I made my money back. And also, if you think of 20, 30, $40, don't sneeze at it, because you do that 10 times and that's $200. For me, the 200 pays my electric bill for the whole month, for example. So never sneeze at money. Never sneeze at $20. Take it. You can always get back in. And now I'm waiting to get back in. Here, I don't like all the gaps, but I might buy one. If it continues down on Monday, I'm going to buy a put over here. And that's KWEB. Let's take another one, maybe. One more. Toast is an example. Oh, I'll show you also JD in a few minutes. Toast. Here's where earnings came out. Let me make these bigger. Where was Toast a trade? It's choppy. I don't like it, but just to pull up an example. Buying puts. Some people are waiting to buy calls on this one. But let's give an example here. Here it is. Way back in the past, but just so you see how it works. This was a year ago. Okay, so here it was in the cloud, and it came out of the cloud. So you see here, the red line is above the blue. The cloud to the right is red. And I would buy here and just hold it. One would be tempted to get out on this green and this green, but it's still, this green candle did not go above the red line. So I was fortunate enough to wait. And it comes over here. And again, it went against me. I was losing money, but it came right back in. And from in about, let's see, how long is that? I always go 4 months out, so I didn't lose that much on the time. So for round number purposes, I can look up the exact amount. It was $20.97 approximately when I got in. And I got out, see, I kept it over here. I got out around here because it was leveling, and you never know it's going to go back up against you. And I had lost money and made money, so I get out. 18 to 21. So that's 300 divided by, it's about $210 on a contract. On a 70 delta. I'll do that in a few minutes. Oh, DBX. Let me show you DBX. One more. Okay. More recent. DBX earnings back in May. Earnings came. Never trade before earnings. Give it maybe 10 days before earnings. At least minimum. But earnings came out here, and notice you'd want to get in this big red candle, but no, because it didn't go in the cloud. Don't get in here, it's green. But you see it went into the cloud over here. But the blue line into the cloud, still in the cloud, still in the cloud, still in the cloud over here. I don't know if people can see my cursor. Let me get something to draw with. I guess this works. What is this here? Okay, this works. Okay, so over here, no trade, no trade here, no trade here because it's in the cloud. But now it came out of the cloud. Notice also over here, even it came out a fraction of a millimeter, but the blue line was above the red, so it's not a trade. Now, here we have the red, but the blue line is just crossing. Don't buy it, the cross. Here would be the trade. Right over here would be the entry. It's letting me guess it changes. Here it is. The entry right over here. Okay, so notice how it's in my favor, and then at this big candle, I would still keep it. Maybe getting out over here would be a good idea. To sell the put down here. Remember, you've got to go out maybe 4 months, and the stops are going to be deeper than most regular trading styles, because the stop is going to be, if you got in here, the stop's going to be in the middle of the cloud here. Here would be the stop. So if it goes against you, you'll lose about 50%. But if you go out 4 months, 5 months, there's a pretty good chance it's going to come back in your direction, at least a little. So many times they go against me and I want to get out, take a loss, figured, I'll wait because I have 4 months. And about 72% of the time, either I get my money back or I'll make a little $10 on a losing trade. And I'm thrilled with the $10. Is there another one here? Oh, SLB. Let's go to Schlumberger. I normally don't like to buy puts on big, famous companies because the big, huge buyers, the institutions, can do whatever they want with it. But just so you have another example. Also, I try not to buy puts if the SPY is moving up, I don't buy puts. Wait to buy puts in a bearish market. But just for the fun of knowing for the future. Now we're in either a level market or maybe a bullish market a little. I would say level. It's not doing much. But take, for example, here was the earnings going back. Let's go to past a cloud. Okay. So don't trade here because earnings is coming up. The earnings on Schlumberger came in over here. It doesn't follow the rule because, see over here, all the price, none of it's in the cloud. Here it jumped below the cloud. So this is not a trade because there's nothing in the cloud here. Nothing in the cloud here. But see if there was one over here. Now here's where there'd be a trade. Coming to more recently, after earnings, is that 26 days? This was, okay, so at the present time, the cloud to the right is red. Here was that 26 days? Yes, it was. So the cloud still was red. Okay, so notice over here is in the cloud, in the cloud, in the cloud. And now it comes out of the cloud. Some people will trade on the first day. I'm finding more modern times, when I was taught in Japan on this, more modern times, I think, because of the technology changing, people can buy on the first day it comes out of the cloud. I was taught to do the second day down here. But still it would be a little money, just a little, but just to show how it works. It's in the cloud. The red line is above the blue here. The lag is pointing down. And I would keep watching this one for puts. If if Slumberger comes back up to the top of the cloud and starts moving down, I'd be buying a put on it. Just want to avoid risk. And now I want to show you how to order the puts. How to bring a put up. So let's just take one. Let's just bring up. Here's one more that I made on a few times. Okay. Little money here, a little money here, but my point is just a little. I think here's another one. I only made $20, but I was happy with my 20 because it had gone against me. Here I made a little more than that. But just so you see how it works. I'm going to bring this one up because I traded it recently. Here's how you find the options. So bring up the options. And just for example, why is it slow? Okay, so you see here, I would go out right now. I would go out to January, minimum of December, but I'd go out to January. And you look for the price is 27. So let's bring up a January put. I'll do 2 of these just to show how to buy a put. Most brokers will not let people short a stock. There's unlimited risk. But buying a put is only the risk of the put. Okay, so here it is. January, I'm looking for the delta is over here. So 62 is okay, 75 is okay. What the 62 means is that approximately, because you're dealing with time value, I won't get into that for this video. You're dealing with how fast it changes, volatility. But for simple purposes, this 62 means for every dollar the stock moves down, you will make approximately 62 cents. I used to buy 50 deltas, but then at Right Way Options, the moderator of Right Way Options taught me to do only 70s, and it's been working better. Is Doug Campbell taught me that. So here's the 62. If it moves in your direction down, you're going to make 62 cents for every dollar it moves down. Notice the price is 27. So if you shorted at 27, you'd be putting out $2,700 because for 100 shares, to short 100 shares. When you short something, you're not really shorting it because the broker has to locate and borrow those shares so that you can sell them. That's another video. So this is why to buy puts. So if you were to short it directly, you'd have to put $2,700 out and you'd make $1 for dollar. But if it goes against you, you're still responsible for that 27. If that stock moves up to 100, you'd have to be spending, what is that, 100 times that, what is that, $100,000, 10,000 something? It's unlimited crazy risk shorting. You're going, so here is, so I'm happy with the 62. Also, here's 75 cents. So here I put out, I won't go on a $27 stock. Of course, I'm doing this off hours, so the bid and the ask is not correct, but I'll get into that in a second. Okay. I would not give more. This is $5.95 on the bid, which just means how much, and $6.95 is $1 difference. I would not go more than 10 cents on a $27 stock. I would not give more than $6.05, maybe $6.10 for this. So you're going to spend, say, round number purposes, $600, and you'll make 75 cents for every dollar it moves down. So if it moves down to 26, I'm assuming you just buy one contract. So for example, can I get I have to get this off. So take for example here at 27, and it went down to 25.50. So multiply that out on 75 cents per dollar. What, 150 quick dollars? Is that approximately, round number purposes? Let's show another one that I've done with the put. What have I? Let's just take KWEB for example. Just an example to show how to buy the puts. The bid is how much you would sell it, and the ask is how much you buy. So take, for example, here is the Chinese internet stock, and say somebody bought here on this red candle. I wouldn't buy here because the blue is above the red, but imagine somebody bought on this big red candle 26.53 and got out and sold it at 24. So for round number purposes, again, $2 at a 70 delta, $140 on one contract. So take, for example, you look at the puts, go back to January. Oh, I didn't have to do open interest. Let me show you that in a minute. That I forgot. Let me get back into that. Okay, so let's go to January. And there's plenty of open interest. So come over to, here's a 71 delta. 6,000 contracts are, almost 7,000 contracts are in the books. If you look at open interest, it shows the amount of people that are trading this approximately. How much is available to buy and sell. So here's 375, and if it goes in your direction, $1, or say it goes in your direction $2, you'd make $140. If you buy two contracts, each contract is 100 shares. Over here, I have a rule on the open interest. I like it to be in the thousands, but if I'm only buying one contract, I'll accept 200 over here. One or two contracts. I'm going to show you how I find the trades in a minute. Okay, so let's bring. So notice over here, these open interest, it means there's a lot of people interested in it. That there are plenty people to sell it to once you buy it. But come over here and look. There's 0, 0, 195, 48. Of course, it's a 93 delta, but still, just to show the concept. Okay, come back into January 20. January options. Okay. Wait a minute. Let's just find somewhere that's very low just to show the idea. Well, 753 is low. There's got to be some that. Okay. Look, 78 cents on the dollar approximately. There's only one person on it. Of course, it's all the way out into March. By 2 or 3 months, I might be 500 or 600. See here, 200 maybe is okay. If you only buy two contracts, 200 would be sufficient, because the spread is 475 to 485. I would give 10 cents for that. And I'm going to show you how to bring up an order. Let me show you the live trading alerts first. I hope this is sharing. Okay, so I have my windows up here. And I want to bring up, here's the window that I did. I hope this is sharing. I'll find out. Okay, so I have my windows here that I made from Ed Carter's live trading alerts. To buy puts, I'm going to look at the bearish Ichi price crosses below the cloud. And this would be from Friday, August, what day was that? 30th, I think. It was August 30th. Okay, there was only one, and it was X. So let's look at X. Let's bring back X and see what's happening here. Okay, so only one came across the scan. Oh, I'll show you what I put in for the scan. But here's X, just for the fun of it. You see, so this is the scan today. This is not a trade because this is green over here. But when you bring up the scanner, I never trade the scans the same day. I wait and watch it, make a list and watch. So if this goes below here, the red is above the blue, so yes. This is just not even, it crossed it, but then came back up. This is just one to watch for puts. When this goes, when the right side over here goes red, I might buy a put on this. But it gives one to watch. Let me show you how I figured that trade out. I do it daily like this. I'm a simpleton. There's fancy ways people do these, but okay. So now I'm going to show how I built this. Okay, so these are this is what I used to build it. I want the price below the cloud. I have a I want the price between 10 and 50. I want the average volume over 1 million. I want the market cap over 2 billion. I want a red candle down or a red candle. It says black, but it's red. And if it meets all these, it will come up in the scanner. Just to show how I find them. It's trading puts. It's a lot different than trading calls because the market is designed to go up. So you have to go in and out really, 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 really fast with the puts as soon as you make money. Okay, so let's see here. And then I want to show maybe how to do the order, how to put in an order for puts. And that would look like this. I know I had it ready. Let me find it. No? Okay, so here we go. Maybe here. See if I can share the screen here. Maybe it's sharing. Okay. So I'm just for the fun of it, I'm going to enter. You would enter. Let's just take hood. It won't matter which one. Okay, so it's going to ask you for a strategy. I want a put. I want to make money if it goes down. I'm going to buy to open, just say 1. I would never do September. Let's go out till January 25. Let's look at a chart of hood. Maybe a put here. This might, I don't like the blue line above the red, but I would wait on this one. This is one to watch and wait is hood. If the red goes above the blue, it might be for a put. Just something to watch. It's if one wanted to take the risk, it might be a buy now. The lag is just coming below the cloud, but just for the fun of it. So what's it priced at? 2021 now? 2012. So let me come back to that other screen. I want, oh, up, up, up. Okay, so let's see what I'd want here. Come to approximately January, somebody might do December. But because it's the cloud, you want to give yourself a longer time in case it goes against you. So let's take a look at the deltas in hood, 650 by 660, not too. There's only 116, but if you only buy one or maybe two, maybe okay. Because remember, it's out till January, so this open interest is going to increase by then. But just to show how to enter the trade. So you see the bid, you would buy for 660, and when it goes in your favor, you're going to sell at the bid. So bringing, oops, wait a minute. Nope, wait a minute. I have to figure out how to do this now. Maybe here. Maybe. Okay, so, oh, maybe here. Here it is. I hope it's sharing. Oh, wait, here it is. It should be sharing. Okay, so I'm going to buy to open one. And here is 2014. So I don't remember the strike price. What was that? It was around $6. What was that? I have to go back again because my head's not here. That was January 26. So move this up to 26. And I put my order in 650 by 660. I would put it, and if it were in the market, I would accept the 10-cent difference. If somebody got really, because never get petty over 5 cents. If I really wanted it and it was 4.45 and the market's closing, I would take it at 660. Usually when I put the order in, you're going to select it market. That's when you either accept what the broker will give you, probably 660. Usually I get it for less, usually I get it for somewhere in the middle, a few cents less. Or a limit, you tell how much you want. So 550 by 560, I would type in, 650, I would type in 6.55. And I'm not going to send the order. All or none means, oh, I see, this one is only, some of them is only 10 cents. It won't permit it. It won't permit in the middle. It has to go by 10, 20, 30, 40, 50 cents. Some of them. A valid limit price. So 660, the market's closed, but there's a way to do it. So that's the general idea of how to enter a put trade. I don't like to give the brokers more than, depends on the price of the stock. So I'll get this back here. If it's, I don't know, up to maybe $50, I won't give more than 15 cents spread. So that is how I trade the Ichi Moku's buying a put. Let's just take the diamonds and one more example, and then I'll end the video for tonight. See here, the market's moving up. I wouldn't be buying puts, but just because I'm doing a video on puts, let's go back in the past where it looked like it would be going down. So here's the diamonds, that's the Dow Industrials divided by 100. So here's an entry for a put over here. When was that? A year ago, September of 23. And it would have been some really good money. getting in over here and getting out. So that will conclude for tonight's lesson on trading the Ichi Moku's. And I'm Jeff Sirkin in New York City. And you all have a good night. And thank you for watching. And if you like the video, click like. I'll do more videos. And you can subscribe. This is only my third video, so I think I'll get better as time goes. But thank you for watching. And I'll end the recording here.